Ready to pass the CPA exam faster? Visit cpapass.ai. Today, balance sheet transactions. How to classify assets and liabilities on FAR. The balance sheet, or statement of financial position, is a financial snapshot taken at a specific point in time. Think of it using the bank statement analogy. When you log into your bank app, you see your balance at that exact second, not a movie of your monthly spending. This snapshot is governed by the fundamental accounting equation: assets equal liabilities plus stockholders' equity. You can easily remember this with the mnemonic ALE, like a glass of ale. Assets represent the economic resources your business owns, such as cash or equipment. Liabilities are the obligations your business owes to creditors. Equity is the residual interest left over for the owners. On the CPA exam, this equation must always balance. On a classified balance sheet, we separate assets into current and non-current categories based on liquidity. Current assets are resources a business expects to convert to cash or consume within 1 year or one operating cycle, whichever is longer. Examples include cash, accounts receivable, and inventory. In contrast, non-current assets are long-term resources held for more than 1 year. These include tangible items like equipment and buildings, as well as intangible assets like patents. Understanding this distinction is critical for evaluating a company's short-term liquidity. The examiner expects you to know exactly where these items belong. Misclassifying a long-term asset as current is a major error that distorts key financial ratios. Just like assets, liabilities are classified on the balance sheet as either current or long-term, depending on when the obligation is due. Current liabilities are obligations the company expects to settle within 1 year. This includes day-to-day operational debts like accounts payable, accrued wages, and taxes owed. Long-term liabilities are obligations due beyond 1 year, such as long-term bank loans, bonds payable, or notes payable. Properly separating these categories allows financial statement users to assess the company's solvency and debt structure. On the CPA exam, look closely at the maturity dates of notes payable to determine if any portion must be reclassified as a current liability. Let's see the accounting equation in action using a worked example for Sam's Bakery. Suppose Sam's Bakery has total assets of $50,000 consisting of cash, ovens, and ingredients. If the bakery has $20,000 in liabilities from a bank loan, we can verify that stockholders' equity must equal $30,000. This maintains our fundamental balance. From here, we can also evaluate liquidity using working capital, which is calculated as current assets minus current liabilities. This metric tells us if a company has enough short-term resources to cover its immediate debts. Understanding how these classifications flow helps you verify that the balance sheet is structurally sound before analyzing deeper performance metrics. To pass FAIR, you must avoid common examiner traps. First, watch out for policy versus detail confusion. Candidates often mistake high-level accounting policies for detailed transaction disclosures. Second, master the disclosure versus correction trap. You cannot simply disclose an error in the notes to correct a misstated balance sheet. A formal journal entry correction is required. Remember, under GAAP accrual rules, receiving cash does not equal revenue. Unearned cash, like gift cards, is recorded as a liability, not revenue. Finally, notes to the financial statements are never optional. They are required for a complete set of GAAP reports. Practice these classification scenarios at cpapass.ai to master these tricky balance sheet concepts.